Welcome to the Australian Property Investment Podcast with your host, Aaron Christie David. Each episode, we ask an expert to share their key insights for aspiring investors to make confident property choices.
G'day and welcome to another episode of the Australian Property Investment Podcast, all about helping you make better property choices. I'm Aaron Christie David, founder of ATO Wealth, a mortgage broking business specialising in helping property investors. Join us each week as we speak to leading experts in their field to ask them the three most common questions that investors ask us. Today, we're really lucky to have Tuan from Duo Tax join us in the studio, mate. G'day, how you doing?
Good, thanks. Aaron. Thanks for having us today. So really good to have share some insights on tax depreciation.
No dramas at all, mate. Tuan, you founded Duo Tax Quantity Surveyors, so you're a tax depreciation specialist, mate. So we'll go a little bit deeper into that. But a bit of background, mate, you come highly regarded. You took out Parramatta's Business Person of the Year in 2018, which is made a great accolade. Congratulations.
I appreciate that. I think it's a testament to the team that supports us here at Duo Tax. As we specialise in just the one service and product, being
Beautiful.
Tax depreciation, gives us a real opportunity to really excel at it.
Beautiful, mate. We'll talk all things depreciation schedules in a minute. I just want to make a note that anything we do discuss is of a general nature and doesn't constitute financial advice. So if you do want to reach out and have a chat about your financial situation, our details are hello@atelierwealth.com.au, and we'll also include your details, Tuan, in the show notes as well, mate. But let's kick off and let's really start with, mate, the big question, which is what is a depreciation schedule, mate, and what does an investor need to know about it?
Yeah, great question. And I think that's the most common question I get from a first-time investor, even referred by someone such as yourself or even an accountant. So the question being, what is a depreciation schedule? Ultimately, when you've got a rental property that you purchase as an Australian taxpayer, you are entitled to claim tax deductions on losses to the property. That might include, obviously, your property management fees, any interest that you pay on the loan. You might have your pest and building inspection or your regular yearly routine inspections. They're losses to the property, so they're tax deductible. On the other note is depreciation. So your building does incur depreciation from year to year. And as part of that, the ATO recognises that is a loss and you are entitled to claim that as a tax deduction. So in order to claim the depreciation as a tax deduction, you need to organise a quantity surveyor, such as ourselves, to prepare this tax depreciation report. And ultimately, that is an ATO-compliant document that we prepare to provide you with tax deductions year on year for as long as you hold that property.
Excellent, mate. And so, as I'm an investor, you're an investor. When does someone engage yourself and your team, mate?
That's a great question. Yeah. So we obviously, as quantity surveyors, are registered with the Australian Institute of Quantity Surveyors, and ultimately, a quantity surveyor is providing, as professionals, we estimate the cost of construction, and the right time to prepare a depreciation schedule is when you first buy the investment property. Duly because it's usually vacant in that period. And if so, that would be the best time to get us out.
Lovely.
Or during the time that you're preparing your tax returns. Because the reports are prepared retrospectively. So if you do get these reports 1 or 2 years late, which is, I think, an abundance of our clients, it is not a serious issue because we are able to backdate the reports from the date you settle on the property or when you first start renting the property. But it is wise to note that we can only amend 2 years worth of tax returns as an individual taxpayer, or 4 years as a company. Those are the deadlines, and that is 2 years from the date of notice of assessment being released.
Okay. Yeah. So good to know it's never too late as an investor.
Generally, never too late. Better sooner than later.
Yeah.
As there is a 2-year deadline, but if you are sort of a few years late into it, it's always worthwhile to ask the question to us. Provide us with a rental property address, and we'll tell you exactly what sort of deductions you're entitled to claim, and what sort of legislations you fall under.
Perfect. And so what happens in those 2 years if I've done some work to the property? Let's say I've renovated the bathroom or the kitchen, done some work to the flooring. What do you do in that situation?
So with a renovation, if you've recently done a renovation, you either can capitalize those costs into a spreadsheet and provide it to a quantity surveyor or even an accountant if you know the costs from, to the dollars and cents, including GST and whatnot. However, where you've completed the construction and say you've done project manage the whole building yourself or the renovation yourself, you've got hundreds of receipts. You can provide a total sum to the quantity surveyor and we can help you work out the depreciation backwards. So we might say, your oven is worth X dollars amount. And put that into a depreciation schedule rather than putting all the receipts to an accountant. Right. We can work out, working backwards through an inspection, and work out the depreciation schedule from there as well.
Perfect. So is that a scrapping schedule? Because that work is
You can also, with a renovated property, the scrapping schedule will help. So if you've done, say, for example, you've got a property that's still depreciable till today, you then prepare, you've renovated the property. We can actually prepare a scrapping schedule to scrap all the items that you remove from the property prior to renovating it. So, for example, you've got a property that's worth, say, $50,000 in depreciable value as of today, and you decide to scrap that $50,000 to rebuild the house to a $200,000 luxury home. Yeah. You are then entitled to scrap that $50,000 if you've done a complete knockdown. And then prepare a new depreciation schedule to claim the depreciation on the building that's just been erected, and that will be depreciable over 40 years. Where there's a scrap, the $50,000 will be written off immediately. Okay. It's also worth noting that on the 2018 GST Act has been amended, and if you've got a recently renovated property, you are entitled to claim depreciation on the renovated property as brand new. So the ruling with the ATO recently on the 9th of May 2017 is that if you purchase a second-hand property and the property contains second-hand plant equipment such as your ovens and range hood and cooktop and stove and whatnot, you are not entitled to claim depreciation on second-hand equipment. Okay. Now, if you decide to buy that, property as a recently renovated property that's substantially renovated, that is the term the ATO used it, can actually claim that second-hand good, even though you purchased it from someone who's recently renovated it substantially, as a brand new asset. So they have made some exemptions and they have understood that, you are paying a premium for these recently renovated properties and so are entitled to claim depreciation.
Brilliant, which is one of the big questions that we get from recent investors going, there's a lot of legislation changes. Naturally, your business is right on top of this, mate, isn't it?
Correct. Yeah, and we given that we specialize in just tax depreciation work, it's within our scope to know the legislation inside out so we can provide the maximum depreciation possible and help investors, everyday investors, mum and dads, for example, get the most of their cash flow out of tax deductions. Yeah.
Beautiful, mate. Thanks very much. We're seeing a lot of investors start to move to diversify rather than straight residential. Yeah. Commercials become quite popular as well. How does your services work in terms of looking at commercial properties?
Obviously, with that legislation we just spoke about in the 9th of May 2017 legislation, it doesn't affect commercial property investors, whether it's an individual, company, or even a family trust that is buying property or self-managed super fund on the other hand. The legislation only affects residential property investors, whether it's an individual or SMSF. If you buy a property in a company, it is exempt from that 9th of May 2017 second-hand depreciation of plant equipment. However, when you're going to buy company assets when you're buying commercial property, only company, any sort of investor who buys in a commercial property is exempt from the ruling. So you can claim all second-hand plant equipment. And very importantly, as myself, for example, we've bought a commercial property. Yep. We've decided to scrap the property with all the fit out and redo the fit out. Yep. We can claim a huge scrap on that existing fit out and then claim depreciation on the new fit out. So that's a really big bonus for property investors. Given commercial properties are usually bought in different entities to the companies that actually run out of these entities, we can claim both ends, where the SMSF might buy a property, a commercial property, claim the scrap on the fit out, and then the company will claim the depreciation on their new fit out. So that's a very common occurrence as well.
Perfect. Mate, when I speak to new investors about how they got the depreciation schedule organised, sometimes they're not sure if they have or not. And I often say that you guys are a bit like the unsung hero of the property team. You got your buyer's agent, you got your mortgage broker, you got your solicitor or your conveyancer, for example, your property manager. But you guys sit a little bit behind the scenes because you kind of work closely with, say, the buyer's agent or the accountant, for example. So if someone's not sure, that should definitely reach out to someone like yourselves and have a chat, because I think investors really are leaving money on the table because they only really get conditioned to think that the depreciation can come of brand new properties, right? I mean, you guys have probably come across that kind of that line of thinking regularly.
Certainly, and to be truthful with that is most accountants that even refer, being experts in the tax field, they're usually under the same assumption that brand new properties can be claimed. It's not until we sort of get comfortable with working with an accountant over the first year or two that they understand the legislation through advising clients to refer to us, that they can then see the full picture that there's multiple types of property that are available for depreciation. And that being that most properties that are second hand, yes, they might be a little bit older, but the rule with the ATO is under Division 43 capital work deductions, in which we are trying to claim, anything in terms of building costs, which might be the slab, framework, roofing structure, plasterboard, joinery. All those make up about 80 to 90% of the construction cost to a property. The balance being plant equipment, of course. Now, the rule with the building depreciation is that it has to be built after 1987. So, 15th of September 1987 is the cutoff. So, if your building is built between 87 till today, you're entitled to claim depreciation for 40 years. So, if you bought a property that's built in 1990, you can claim depreciation to 2030. So that's another 11 to 12 years in the balance that you can still claim if you bought a property in the last year or two. So that's a really good bonus for them. And also a big pickup that I've noticed a trend is that people are buying property that are generally renovated, and they might not be able to spot it. So they've bought a property that might be built in the 80s or late 80s, and it might not be depreciable under legislation of Division 43. But they go to the property, we'll do an assessment using RP data. So what they do is give us a call, the accountant will refer us on. We ask them for their address, we put it into RP data, which is a real estate software. That gives us the latest photos that are available. We then make an assessment to see if it's depreciable. We notice there's multiple number of times that it's been renovated. We can itemize when the property was renovated, say back in 5 or 10 years ago, and create a depreciation schedule from those different periods of renovation, and that might add value in $2,000 to $3,000 per annum in tax deductions, and to an investor, $1,000 or $2,000 cash flow per year, or $200 per month is a great amount of refund that they can work with, and that only helps them boost their cash flow on top of all the other deductions, and reinforcing the fact that depreciation is a non-cash deduction. Which is really critical, where you are paying for something, you're paying for a report, but ultimately you're not really paying for anything to claim a tax deduction, in which any interest on your repayments for a property, any property management fees, they're all cash deductions where you have to fork out a fee in order to get a deduction. Whereas depreciation is only an on-paper loss, where a quantity surveyor will produce the amount of depreciation you are losing, but ultimately you don't physically have to pay for it if you're not paying for the building up front.
So it's a small cost to incur, but the reward on that, the upside is huge, because it's an ongoing report that can...
That's correct, and I think it's critical to know that it is one upfront fee, and the report is a 40-year report.
Beautiful.
Up to a 40-year report. So you only produce the report once. It's retrospective, and it's also forecasted for the entire life of the building. So you obtain it once, use it for the entire period.
Excellent. So if you're a new investor and you haven't had a depreciation schedule done, reach out to yourself. If you're unsure, have a chat to your accountant as well. I'm sitting here and you've been rattling off dates, legislation. So it's the amount of knowledge that you've got in your head, mate. It's invaluable for an investor. So, and we're really lucky that you've been able to share just a little bit of kind of what swims around in your head, mate. So thank you so much for your time, Tuan, for your insights. As I've said to anyone, if you found this episode helpful, leave us a review, give us your feedback. We'd love if you shared it with your friends and family. Tuan, on behalf of the team, mate, thank you very much for coming into the studio. Until next time, have a good one. Thanks.